Hello, everyone, my dear smart, patient, and value investors. Welcome today to a special edition. Today, we are going to discuss something about the two major banks in India. Right. So, last week, 2 consecutive days, we saw the quarterly results, rather year-end results, I will call for the 5 fiscal year from HDFC and ICICI Bank came out, and both banks did pretty well. Given the state we are right now, all these tariff things were going, banks has been continuously resilient about their performance for last 2 3 months. Right, we are seeing Bank Nifty doing very well as compared to Nifty. I wanted to take a stab at comparing these two largest bank in India, private sector largest bank in India, and compare them. Right, so we'll quickly go through that. But before we go into the details of each bank, as a fundamental investor or as a value investor or as a long-term investor, we have to understand and identify the need first. If the need is very compelling, if the need is very deep rooted, right? If that need of the country or of the world or of the region is such that it is going to last for 5, 10, 15 years, then if we identify a business that is going to satisfy that long lasting urgent need, we can somewhere make assumption that that particular combination of that need and that business is going to last longer, can give little bit better results. And on top of that, if the business that is fulfilling that urgent need is very strong, that's where our multi-bagger returns, low risk, margin of safety, quality of business lies. Right? So that's why first we will spend some time in understanding what is the need that we are talking about. Okay. So quickly, my disclaimer: we are SEBI registered research analyst. This is not a recommendation for anyone to buy a stock. I am just presenting a comparative study of the two largest banks in India. You should consult your advisor before buying. Proper allocation to stock in the well-balanced portfolio is must. Right? Investing in share market is very risky. Again, no sales and marketing, pure knowledge sharing. So sit back and relax. So let's get started. So before we get started, we as a OM research analyst company, we have a mission of making investment in stocks simple, safe, affordable for all, irrespective of your age, education, and pocket size. If you are 10,000 rupees or 10 crore rupees, you should be enabled to invest in stock market by doing proper research and by receiving the proper training. In general, I personally believe that managing risk is more important than identifying stocks with the returns. Of course, we need returns, but first we have to manage the risk. And our risk management is based on 5 different pillars. First is diversification. Everybody knows that. Today, even a KG kindergarten going or nursery going kid also knows that we should not put eggs in one basket. Then diversification across multiple sectors. I'm talking here from a portfolio level point of view. Then we need to have margin of safety. In stock market, there is no guarantee, there is no defined safety. The lower the risk, cumulatively or comparatively, the risk is lower. Correct? So safety in your investment depends upon at what level of the risk you have entered into the market. Now there are a lot of companies or a lot of banks, lot of businesses where you want to enter. And if you really want to make your investment safe, we prefer to choose leaders if we have a choice. And then everybody knows that stock market is risky. And here, when we are saying stock market is risky, we are saying that prices go up and down without any notice. They can abruptly go and down. We call it volatility. So instead of calling it a risk and staying away from the stock market, we try to manage the risk by taking volatility in our stride. We try to take benefit of volatility. And that happens because, let's say, if you want to invest 1 lakh rupees, there is no need to invest all that 1 lakh rupee in one go in one stock. Of course, after diversification, you can, uh, you can stagger your investment across maybe 4, 5, 6 different installments. Sometimes you will buy at higher prices, sometime at very low prices, sometime at average prices, and that's why you will try to reduce the cost of acquisition, thus reducing the risk in your investment. Reducing, I'm not saying eliminating. Okay, risk is inbuilt part of stock market investment. That being said, let's first understand what is the need that banking system solves in our economy. Banking system or banks are not meant for you depositing the money and then somebody taking a loan out of that deposit and bank earning mere interest out of that. This is the business model they have. But banks have a very critical role to play in the entire economy, in the entire financial balance sheet of the country. Right? They are enabler of economic growth. The more stronger the balance sheet of the banks, easier for them to lend to the businesses, to the MSMEs, to the SMEs, to builders for infrastructure development, and so on and so forth. The more liquidity in the market at a lower cost means more business prosperity. So if we are talking about banks, we don't have to only focus on what is the deposit rate and what is the lending rate and what is the difference in margin and all that stuff. We have to also see the intrinsic need of the country that the role bank is going to play. So if you are investing in Indian bank at this situation, at this moment, where we are poised to become a 5 trillion, 7 trillion and $15 trillion economy, banks are going to be the agent of growth. Banks are going to play a pivotal part of country's movement from $3 trillion economy or $3.5 trillion economy to $15 trillion economy. The consumers will be you and me. Consumers will be the infrastructure development companies, the airport authorities, the road development companies, the hospitals who are going to build big hospitals, and the builders who are going to build big malls. They are going to be the consumers. But the agent of the growth are going to be banks. So that is the intrinsic need of the country that one of these businesses is going to satisfy, that we call banks. Now, out of those banks, we have to identify one or two strong banks. So, inherently, we are investing into India's growth story that is inclusive, based on digital transformation and a resilient, inwardly facing consuming economy. In last video, if you have seen it, I have said that we are not only a producing country, we are a self-consuming country also. So that's why all banks are sitting on a inclusive, digital and resilient base. So if we invest in the right bank for next 5 to 10 years, we can see enormous wealth generated for us. So role of Indian banks in 5 trillion economy would be fueling credit growth, making available funds for the different businesses. Everybody should get their share of borrowing so that they can run their business from the operating expenses point of view, from the expansion point of view, from moving from one sector to another sectors. Then digital banking and fintech synergies. We are seeing these Paytms and all these things coming up. Supporting infrastructure build out, we just discussed. And then mobilizing savings for investment. Okay? So that is the role of the bank. Now you understand the need of the country, and you know that now banks are going to be a pivotal play in that. Now let's see these two banks can support that or not. Right? So on to the next one. So in the recent performance, recent quarterly results, we saw, or rather in last almost 5 years, ICICI Bank has grown almost 150%. HDFC Bank has grown around 40%. In last 1 year, ICICI Bank stock price I am talking about, ICICI has grown around 20-21%, whereas HDFC Bank has grown only 14%. So you say, Shrikant, why do you want to carry on with the rest of the videos, the session, right? The entire verdict is here. So no, my dear friends, we need to go a little deeper, and that's why this session is important for you all. So let's talk about, compare them apple to apple. So net interest margin, that is the profit of the company, right? So if you compare bank with other company, net interest margin is the actual profit of the bank. ICICI Bank was 4.41%, indicating a very strong profitability. Whereas on HDFC, it was around 3.46 on the total asset and 3.65% on interest earning assets. Remember, HDFC is the conglomerate of housing development company and the banking. So that's why there are two different metrics. But nevertheless, around 3.6 is their net interest margin. Return on assets, that means the raw material invested and profit generated out of the raw material, ICICI Bank achieved around 2.39%. Correct? That is a significant improvement from their last. HDFC Bank has around 1.7% for last 12 months, but in last 14 quarters, they have been averaging around 1.8% to 2.1%. Comparatively, it seems little bit poorer than ICICI Bank. We'll address that. Why are we still discussing? Then asset quality, correct? It is the strength of the balance sheet, we will call it. ICICI Bank improved to 1.67%, right? So non-performing assets, ICICI Bank had around 1.96% earlier, right? So out of their 100 rupees asset quality, 1.96 assets were non-performing. Now 1.67% assets are non-performing, means almost like 10% improvement in their asset quality. HDFC improved around 1.3%, right? It was 1.42, now it is 1.33. If you guys can see a little bit quality difference, I will call HDFC Bank has a little stable business book, because the non-performing assets of HDFC Bank is lesser than the non-performing assets of ICICI Bank, right? So if you can convert this thing into the risk, you will see that investment in HDFC Bank is a little less riskier than ICICI Bank, right? Again, this percentage small sounds very small, but if you can consider the balance sheet of the bank, this 0.1% also makes a huge difference. So here it is one of the plus point in favor of HDFC Bank, that the asset quality comparatively is better than ICICI. What are the projections? Okay, so ICICI Bank reported around 18% year-on-year increase in standalone net profit, right, reaching around 12,630 crores, right. Total loans grew by around 14%. So retail demand was very strong. So around 14% loan. Loan is basically a sales. So you see, bank ka business model is something like this. Whatever deposit we make or qualified institutional NCDs and other things are there, those are all investment. That is the raw material of the bank. And whatever the loan that is taken from the bank, that is basically a sales of the bank in the normal business comparison. And whatever the interest earned from the loan minus interest paid on the deposit, that is the profit. So if you call deposit as the raw material, then the interest paid to the depositor is the cost of doing business, and the interest received from the loans, the recovery that is made, is basically a net sales receivable, and the difference is the profit. I hope you guys understand this, right? So when I say total loans grew by 14%, it means sale of the company increased by 14%. Deposits increased by 14%. It means the liquidity was very good for ICICI Bank. They didn't have a crunch of liquidity so that they can lend better to the businesses. So their lending capacity, sales paradigm was better, improved. The more money available with the banks, the better chances of disbursement of the loans. If I compare that with HDFC Bank, post merger with HDFC Limited, bank is targeting loan to deposit ratio of 85 to 90% by F27, down from 96.5% in 2025. So what we are seeing here is that currently, before 2 quarters, HDFC was having a very high loan to deposit ratio, which means deposit were little less as compared to in ICICI Bank. So they were having lot of liquidity crunch. So they borrowed from the market. Since they borrowed money from the market, they have to pay little higher interest rate. So their NIMs were getting impacted. And this has happened because of that merger. So the merger of HDFC Bank was like a knee replacement surgery for a big elephant, all the four legs being operated at the same time. So big animal having the knee surgery of all four legs at a time require a lot of recovery time, and we knew that. Now that elephant is back on the 4 feet altogether. So loan to deposit ratio is being managed. If you have read recent news, HDFC has started now reducing the deposit rate. Means they don't need much deposit from retail investors now. They have ample liquidity with them. Their standalone net profit, HDFC Bank, was surpassing the analyst expectations. Right? And that because of the liquidity, and they have paid off all their borrowings. So they were borrowing from the market and lending to the businesses. So they have reduced their borrowings significantly. Right? So that's why their net interest margin is now poised to increase even further. Deposits rose by 5.9%. I just mentioned that. Right? So people are willing to invest, keep money into their saving accounts and deposit more than earlier. So the availability of liquidity with the HDFC Bank is quite good. So why should we invest in either ICICI Bank or HDFC Bank? For ICICI Bank, pros are higher NIM and ROA, strong loan and deposit growth, and improved asset quality. Cons is, again, which I wanted to highlight, is that it is pricey right now, and I will explain why. But they are currently trading at 3 times of their book value. Correct? Whereas HDFC is trading at 2.6 times their book value. The cons with HDFC is that as compared to ICICI, they have lower NIM and little less healthy return on assets. Correct? And the reason for that in that quarter was, as I said, they borrowed somewhere around 60,000 crore from the open market to lend further. So their assets have more liabilities as compared to ICICI Bank. Correct? So here now the strike rate is around 50-50%. Few things are in favor of HDFC, few things are in favor of ICICI Bank. Let's go further. We have to look at now what is in future. So whatever happened till now based on the facts in the past. What we need to see, since we are going to invest for future, we need to see what are their business development plans, what are their strategic initiatives, because what initiatives they are going to take in future, that is going to drive our returns from the stock market. So what happened in the past is the historical data. We as a value investor, we as a fundamental investor has to identify room for comparatively higher growth than its peers. You agree with me? So ICICI Bank strategic initiatives are robust retail and business banking expansion. They have very good retail, right? They are indicating, so they are getting very good in rural portfolio, right? Retail loans are around 53%, and which indicates a very strong business model. If you are a customer of ICICI Bank, you know that by a fact, ICICI Bank's technical platform is far ahead than most of the nationalized private or public bank. And it is not today or yesterday's case. I have been customer of ICICI for almost 23 years now. They are always pioneering in the technology. So that is a plus point with, and lot of digital transformation and operational efficiency we can see in ICICI Bank. HDFC Bank does lag in that area a little bit. But merger synergies that has happened in HDFC Limited and HDFC Bank merger has suddenly created a big animal in lending business. Right? Cross-section selling, cross-selling what we call it, right? Availability of lot of funds. In addition to that, HDFC has focused on deposit growth and liquidity management. That's we've been discussing last 2-3 slides. And also I mentioned strategic borrowing and margin improvement. HDFC Bank has successfully reduced its borrowing by around 60,000 crore over past 2 quarters. This is post-merger, including substantial repayment of commercial loan. So it is no-brainer for any business. If their borrowing goes down and that not only their asset quality improves, their expense also goes down. Right? When you borrow from the market, you have to pay higher interest, and you are a debt return company. Now you are almost a debt-free company, correct? Comparatively. So if you look at it this point of view, still I think ICICI Bank, HDFC Bank compares 50-50%. Correct? On one side, risk is little higher. On other side, asset quality is not that good. On one side, there is a consistent growth for last 5 years. On HDFC side, the growth has been laggard. But if you look at the chart now, or chart is the representation of how price has behaved. This is a weekly chart of ICICI Bank. You can see there has been a sustained growth. There wasn't any systemic internal ICICI Bank related disruptive events which can act as a consolidating factor for the stock prices. It also means whatever good thing has happened and good things are supposed to take place in the next 3-4 years are already priced in. Although we see here that it has given a breakout out of the consolidation right now, but it is the consolidation at the top. All the premium has been already factored it into the prices. So if HDFC Bank and ICICI Bank would have been on the same plate, given everything would have been same, HDFC's price would have been 25% higher than right now. It also means either HDFC is trading at 25% discount. This number is hypothetical for example purpose only. So either HDFC is trading at 25% discount or ICICI is trading at 25% premium. Correct? So let's go and see the chart of HDFC. The consolidation of HDFC is multi-year. This is a weekly chart. So we are talking from somewhere around 2011 or something. Now it has given a multi-year breakout. So the growth that has already happened. So if ICICI Bank would have been consolidation, ICICI Bank would have been trading somewhere around this place. So this particular difference is what HDFC is missing. The breakout given by ICICI is from a small consolidation of 2-3 months. That is from where the Trump tariff, this issue started. Whereas HDFC is a systemic consolidation that has happened for last 6, 7, 8 years. And now the HDFC Bank, the post-merger entity, has reskinned itself. Now the more explosive growth as compared to ICICI Bank is now poised to happen in HDFC. That is my reading. Okay. So if I want to summarize, ICICI Bank demonstrate a strong profitability, no doubt about that, efficient asset quality management also, and proactive shareholder returns. 146% returns in 5 years is a good testimonial of that, no doubt about that. The bank's consistent performance and strategic initiative position it favorably for a sustained growth. Not a single doubt in that. Whereas HDFC focus on post-merger integration, now it is optimizing its loans to deposit ratio, and now it is expanding into loans securitization. The strategic moves of HDFC Bank is poised to give more and faster returns because it is trading at discount and more strategic output is expected in 5 years in speed as compared to ICICI Bank. So both banks present compelling investment opportunity. I think ICICI Bank will grow in a 10 to 12% CAGR point of view, whereas HDFC might grow around 18 to 20% for next 2 to 3 years. So across 5 years or across 10 years, 3 to 5% CAGR differential we can see between ICICI Bank and HDFC Bank given all the factor remains same and constant. right? I believe the growth fact is already factored in ICICI Bank, whereas HDFC Bank is appearing comparatively cheaper, not only from price to book value ratio, as well as from the consolidation phase it has been going through, and the late or lag in the strategic initiatives that took place, right? Because HDFC Bank was focusing on some internal problems, whereas ICICI Bank didn't need to focus on that in that time period, correct? So my analysis says that ICICI Bank has a take forward edge, strong asset quality, expanding, everything is good, but HDFC has a scope and in turns opportunity to earn more EPS, the more earning per share, because it it has been trading at lot of discount as it was going through all these internal disruptions, I will call it. Okay. So now, Shrikant, where should we put our money? My analysis says that both banks are doing good. It will be injustice to one of them if we choose another. I would prefer to invest in both of them conservatively, maybe 50-50. If you are an aggressive investor, maybe 60% in HDFC and 40% in ICICI Bank. And if you have a well designed portfolio, and if there is no bank exposure, then I will prefer to have a small exposure in that portfolio to HDFC Bank only. So if you have a diversified portfolio, so I will not have ICICI and HDFC both. I will prefer to have HDFC. By the way, disclaimer is that we have a long-lasting position in HDFC Bank taken long back. All right, so we are little invested in HDFC Bank already. Correct. So this is the quick verdict. I hope you are getting it. But this is what we do. We help you to take right decisions. Right. Emotions are important, but we help you to use emotion at the right place. Right. We are an information and analysis driven research firm. We don't work on speculations, skepticism, gut feeling, right? We depend totally on our research. So that's where we are, friends. We have a stock study katta where it's a WhatsApp group where we discuss stocks, investments for learning purpose, right? So if you are interested, you can join our WhatsApp group to learn. If you have any questions, these are my credentials. This number is there on the WhatsApp. You can send me your questions and I'll be happy to answer you. Right. So thank you very much, friends. Look forward to hear your comments. If you like the video, do please subscribe to the channel and like the video. It will help me. It will motivate me, and it will inspire me to bring more such videos to all of you. Thank you very much.